Picture this. While most investors are chasing expensive tech giants and blue-chip stocks, there is a completely different world of opportunities trading under $5 that could potentially multiply your investment several times over. I'm William, and on this channel, I break down investment opportunities that Wall Street often overlooks, bringing you detailed analysis of undervalued stocks with real potential. Today, we're diving deep into penny stocks in the fintech sector that are quietly building massive user bases in one of the world's largest consumer markets. Now, before you click away thinking this is just another risky penny stock pitch, let me tell you something that might surprise you. The two companies we're exploring today aren't some obscure startups operating out of a garage. These are established financial technology players with millions of active users, real revenue streams, and partnerships with some of the biggest names in their industry. But here's the catch that most people miss. They're trading at a fraction of what many analysts believe they're actually worth. So if you understand that real wealth isn't built by following the crowd into overvalued stocks, but by identifying undervalued opportunities before everyone else catches on. Stay with me for the next few minutes because what I am about to share could completely change how you think about penny stock investing. Let's talk about why penny stocks under $5 even matter in today's market. The conventional wisdom says stay away from anything trading below $5 because they're too risky, too volatile, too speculative. And you know what? That conventional wisdom isn't entirely wrong. But it's also not entirely right. The reality is that some of the biggest winners in stock market history spent time trading under $5 before they exploded. Amazon traded under $5 in the late 90s. Apple traded under $5 after adjusting for splits. The point isn't that every penny stock will become the next Amazon. That's ridiculous. The point is that price per share means absolutely nothing when it comes to a company's actual value or potential. What matters is the underlying business, the fundamentals, the growth trajectory, and whether the market has correctly priced in the company's true worth. And that's exactly what we're going to examine today with surgical precision. The fintech sector has been revolutionizing how people access credit, insurance, and financial services, particularly in emerging markets, where traditional banking infrastructure has left hundreds of millions of people underserved. We're talking about markets where a huge portion of the population never had access to personal loans, credit cards, or affordable insurance products until technology companies stepped in to fill that massive gap. This isn't some theoretical opportunity. This is a multi-trillion-dollar market being transformed right before our eyes. The companies that have positioned themselves correctly in this space, the ones that have built the technology platforms, the user bases, and the regulatory relationships, they're sitting on potential gold mines even if their stock prices don't reflect it yet. One of the most interesting aspects of fintech in emerging markets is how quickly adoption happens once the infrastructure is in place. First comes skepticism, then comes gradual adoption. Then suddenly you hit an inflection point where growth becomes exponential because the network effects kick in. More users attract more financial partners create better products attract more users, and the flywheel starts spinning faster. So let's dive into our first company, and I want you to pay very close attention because the numbers I'm about to share are going to surprise you. Lexin Fintech Holdings, trading under the ticker LX, is currently priced around $3 per share, which means you could buy 300 shares for less than $1,000. But here's what that $3 is actually buying you. Access to a company that operates one of China's largest online consumer finance platforms, serving primarily young, educated consumers who are just beginning their credit journeys. We're talking about a platform called Fenkile that has facilitated over $100 billion in loan transactions since its inception. Let me repeat that, over $100 billion in cumulative loan originations. In their most recent quarter, Lexin Fintech reported total loan originations of approximately $8.9 billion, and here's the kicker, they're doing this while maintaining a take rate of around 7 to 8%. That means on every dollar of loans facilitated through their platform, they're capturing 7 to 8 cents in revenue through various fees and interest income. Now let's talk profitability because this is where things get really interesting. Unlike many fintech companies that burn cash trying to grow, Lexin Fintech has actually been consistently profitable. In recent quarters, They've reported net income in the range of $40 to $60 million per quarter. On an annual basis, we're looking at a company generating somewhere between $160 to $240 million in profit, and it's trading at a market cap of only around $400 million. Think about that for a second. You're essentially paying less than 2 times annual earnings for a profitable, growing fintech company. The traditional price-to-earnings ratio for growth companies in the financial technology space typically ranges from 15 to 30 times earnings. Even if we apply a conservative multiple of just 10 times earnings to Lexin Fintech, you're looking at a potential valuation of $2 billion, which would represent a 5-fold increase from current levels. Here's what most investors miss when they look at Chinese fintech stocks. They see the regulatory headlines, they see concerns about the Chinese economy, and they immediately run for the hills without actually examining the underlying business fundamentals. Yes, China has implemented stricter regulations on consumer lending, but Lexin Fintech has adapted remarkably well. They've shifted their business model to focus more on serving as a technology platform that connects borrowers with licensed financial institutions rather than taking all the credit risk themselves. This asset-light model actually improves their capital efficiency and reduces regulatory risk. Lexin Fintech has established relationships with over 100 financial institution partners, including major Chinese banks and consumer finance companies. These aren't small regional players. We're talking about institutions like Bank of Communications and China Guangfa Bank. What Lexin Fintech brings to the table is something these traditional financial institutions desperately need: technology, user acquisition capabilities, risk assessment algorithms, and access to a demographic that's historically been underserved by traditional banking. The user metrics are equally impressive. Lexin Fintech serves millions of active borrowers, and their focus on quality over quantity is evident in their credit metrics. They maintain delinquency rates that are actually better than many traditional credit card portfolios, with day-15-plus delinquency rates typically in the single digits. They've also been expanding beyond just personal installment loans into other financial products. They offer wealth management services, insurance products, and they're rebuilding out a comprehensive financial services ecosystem designed to capture more wallet share from their existing user base. When a customer who came to your platform for a small personal loan ends up also buying insurance and investing through your wealth management products, the economics become extraordinarily attractive. Now, let's shift gears and talk about our second opportunity, because this one comes from a completely different angle within the fintech space. Waterdrop Inc., trading under the ticker WDH, is currently hovering around $1.50 per share, putting it firmly in penny stock territory. But don't let that low absolute price fool you. This company is attacking one of the largest underserved markets in the entire financial services industry: health insurance and medical crowdfunding in China. Here's a statistic that should blow your mind. Despite having the world's second largest economy, China has historically had massive gaps in health insurance coverage, particularly for serious illnesses and catastrophic medical expenses. Hundreds of millions of Chinese citizens are either uninsured or severely underinsured. When it comes to major medical events, Waterdrop recognized this gap and built a platform that addresses it from 2 angles simultaneously: medical crowdfunding and online insurance distribution. Their medical crowdfunding business operates under the brand Waterdrop Medical Crowdfunding. This platform allows individuals facing serious medical expenses to raise funds from their social networks and the broader community. Since launching, Waterdrop's crowdfunding platform has helped raise billions of yuan for individuals facing medical crises. But here's the brilliant part: the crowdfunding platform isn't primarily a revenue generator, it's a user acquisition engine. When someone donates to help a stranger pay for cancer treatment, they become aware of Waterdrop as a brand. They internalize the message that medical expenses can be financially devastating, and they become highly receptive to purchasing insurance products to protect themselves and their families from similar situations. The real moneymaker is Waterdrop's insurance platform, which distributes health and life insurance products from over 100 insurance carrier partners. In recent quarterly reports, Waterdrop has been facilitating insurance premium payments running into the hundreds of millions of dollars per quarter. Their business model is straightforward. They earn commissions from insurance companies for every policy sold through their platform. typically ranging from 10 to 30% of the first-year premium, plus renewal commissions in subsequent years. The beauty of the insurance distribution business is that once you sell someone an annual or multi-year policy, you continue earning renewal commissions year after year with minimal additional customer acquisition costs. In their most recent financial reports, Waterdrop has been showing operating premiums exceeding $1.5 billion in an annual run rate. Now, let's talk about profitability, because this is where Waterdrop's story gets particularly interesting. The company has been on an aggressive path toward profitability, dramatically reducing their net losses quarter over quarter. In recent quarters, they've gotten very close to break-even on an operating basis, with some quarters showing positive operating income. Their gross margins are exceptional, typically in the 70 to 80% range, because they essentially running a technology platform that connects buyers and sellers of insurance without having to take on any underwriting risk themselves. As they scale and their brand becomes more established, customer acquisition costs should continue declining, which means those already impressive gross margins should translate into increasingly attractive operating margins. The strategic positioning of Waterdrop is absolutely fascinating. They're not trying to become an insurance company themselves, which would require massive amounts of capital and regulatory complexity. Instead, they're building the distribution platform that connects consumers with insurance providers. Waterdrop has over 100 million registered users on their platform, which gives them enormous leverage when negotiating with insurance carriers. Insurance companies are desperate to access Waterdrop's user base because acquiring customers in China's insurance market is incredibly expensive through traditional channels. Waterdrop delivers customers at a fraction of that cost because of their crowdfunding platform's spiral effects and their sophisticated digital marketing capabilities. They work with virtually every major insurance carrier in China, including companies like China Life, Ping An Insurance, and CPIC. Looking at the valuation perspective for both companies, we need to consider where these stocks could potentially go if they simply revert to normal market multiples. Lexin Fintech, profitable with strong cash generation, trading at a tiny multiple of earnings, represents a potential value play. If sentiment toward Chinese fintech improves even modestly, or if the company continues executing and investors start paying attention to their consistent profitability, a move back toward a market cap of $1 to $2 billion is entirely plausible. Waterdrop, approaching profitability with a massive user base and strong unit economics, could similarly see substantial revaluation if they achieve consistent profitability and demonstrate the long-term value of their insurance distribution platform. Now, let me quickly walk you through this infographic that summarizes everything we've covered today. On the left, we have Lexin Fintech at $3 per share, a profitable consumer lending platform with $8.9 billion in quarterly loan originations, partnerships with over 100 financial institutions, and trading at just 2 times earnings with potential 5-fold upside. On the right, Waterdrop at $1.50, an insurance distribution and medical crowdfunding platform with $1.5 billion in annual operating premiums, over 100 million users, approaching profitability with 70 to 80% gross margins. Both companies serve massive underserved markets in China's fintech sector with real revenues, real users, and significant revaluation potential. My recommendation: these stocks deserve serious consideration for investors seeking asymmetric risk-reward opportunities, but remember to do your own research, never invest money you can't afford to lose, and maintain proper portfolio diversification. Here's the infographic summarizing our analysis. Lexin Fintech at $3, profitable with massive loan volume. Waterdrop at $1.50, approaching profitability with huge user base. Both offering significant upside potential in underserved fintech markets. If you found this analysis valuable, hit that subscribe button and let me know in the comments which penny stocks you'd like me to analyze next. Until next time, invest smart and stay ahead of the market.